All right, let's dive into one of the absolute cornerstones of trading, learning how to actually read a price chart. Today, we're going to break down the core concepts of support and resistance. You know, when you first look at a price chart, it just looks like a chaotic mess, right? Just a random line bouncing all over the place. So the big question is, how do traders find any kind of order in that madness to make smart decisions? Well, that's exactly what we're going to unpack. So here's our game plan. First, we'll cover the basics. What are support and resistance? Then a really key point, why you need to think in zones, not exact lines. After that, we get to the cool part, when these levels switch jobs entirely. Then we'll zoom out and see how to find trends. And finally, we'll look at how traders actually use all this stuff. Let's get to it. Okay, first things first. We have to understand the basic building blocks. And honestly, the best way to think about support and resistance is to picture the price moving around in a room, with a floor below it and a ceiling above it. Let's start with support. This is our floor. Imagine the price is falling, and it hits a level where a whole bunch of buyers think, hey, that's a good deal. They start buying, and that wave of demand creates a sort of safety net that holds the price up and hopefully makes it bounce. And on the flip side, you've got resistance. This is the ceiling. It's a price where sellers start to get antsy and think, you know what, this is a pretty good spot to sell and take my profits. All that selling creates a wall of supply that can stop an uptrend in its tracks, pushing the price back down. Okay, now here's a crucial tip, and it's where a lot of new traders got tripped up. It's so tempting to look for one single exact price. But believe me, the market is almost never that clean. In fact, being too precise can actually hurt you. And here's why. Support and resistance are not laser-thin lines. They're more like blurry areas or zones. If you get obsessed with one specific number, you're going to get faked out when the price pokes just a little bit past it and then snaps right back. Thinking in zones helps you filter out all that market noise and see what's really going on. All right, now for the really fascinating part, these floors and ceilings, they're not set in stone. They can and do break. And when they do, they often pull off this amazing switcheroo. Check out this diagram up top. So the price is pushing and pushing, and it finally smashes through that resistance ceiling. What happens next is amazing. That old ceiling often becomes the new floor. Traders will watch to see if the price drops back down to test it, and if it bounces, that's a huge confirmation that the old resistance is now new support. And yep, you guessed it, the exact same thing happens in reverse. If that support floor gives way and the price falls through it, that old floor can become the new ceiling. The price might try to rally back up, only to hit its head on what used to be its safety net. This is what traders call role reversal, and it's a super powerful concept. So now that we get these individual zones, let's zoom out a bit. When you start connecting these dots on a chart, you can suddenly see the bigger picture, the trends and channels that are guiding the price along its journey. So in an uptrend, the price is making a series of higher highs and, crucially, higher lows. You can actually draw a trend line by connecting the bottoms of those little dips, or valleys. That line gives you a clear visual of the trend's general direction. And for a downtrend, it's the exact opposite. The price is making lower highs and lower lows. So this time, you draw your trend line by connecting the tops of the bounces, or the peaks. It perfectly maps out the path the price is taking downwards. But we can take this one step further. If you draw another line that's parallel to your uptrend line, connecting the peaks, you suddenly create this ascending channel. It's like a corridor that contains the price action as it climbs higher. And no surprise here, it works just the same for a downtrend. Draw that parallel line across the bottoms and boom, you have a descending channel. It gives you a really clear, downward sloping path that the price is respecting. Okay, so the theory is great. We can spot the levels, we can draw the lines and channels, but the million-dollar question is, how do you actually use this information? Let's talk about turning all this analysis into actual trades. When it comes right down to it, there are really two main ways people trade these levels. The first is trading the bounce. You're basically betting that the floor or ceiling is gonna hold strong. The second is trading the break, where you're betting that the level is going to fail and the price is gonna power right through. Now, if you're playing the bounce, you can't just blindly place an order the second the price touches your support zone. That is a classic recipe for disaster. It's called catching a falling knife for a reason. Smart traders wait for some kind of confirmation, some sign that the level is actually holding before they jump in. Okay, but what if you're convinced that level is about to shatter? What about trading the break? Here, you've got two main styles. There's the aggressive way. You enter the trade the very moment the price slices through that zone. Then there's the conservative way. You patiently wait for the price to pull back to that level it just broke, and you only enter after it confirms that old ceiling new floor trick we talked about. And you can see the difference so clearly here. The aggressive entry on the left is all about speed and momentum. It can be very profitable, but also risky. The conservative entry on the right is about patience. You might miss the initial explosive move, but you're trading that for a much higher probability that the breakout is the real deal. I love this quote from Peter Drucker because it applies perfectly to trading. You can have the fastest, most efficient system for placing trades, but if you're trading at a random spot on the chart, it's completely useless. Understanding support and resistance is about finding those key places where taking action actually makes sense. So if you take away just one thing from all this, let it be this. Support and resistance levels are not crystal balls. They are not guarantees. They are simply zones where the odds shift. They're a tool, not for being right 100% of the time, but for helping you manage your risk and find opportunities where the probabilities might just be tipped in your favor. The real question is, can you spot the floor before it breaks?